Yeah, I think many times in life we are confronted with exactly these types of odds where if you go for something, it could be a winner, and the downside is very limited. From taking a random meeting with a stranger to a variety of other things that you might engage with. I think Michael Jordan said you miss all the shots that you don't take. So basically sometimes going for a few things, even if it's not a 100% sure bet, can work out really well in life. And I think one of the misnomers that people have about entrepreneurs is that they think entrepreneurs are risk takers. And actually the reality is the complete opposite. So if I look at startups, and I would put startups into two different categories: venture backed startups and non-venture backed startups. Non-venture backed startups make up 99.999% of all startups. And venture backed startups actually are the anomaly. So I'm not talking about venture backed startups. We can ignore those startups. But non-venture backed startups basically tend to have entrepreneurs who tend to, even though they don't think about it in this format explicitly, they do everything in their power to minimize risk. And I gave the example in my book that, let's say there's a barber in a small town, and he has a barber shop, and he's got customers, and he's kind of doing okay. But there's just about as many barbers as are needed in that town. So no one just does extraordinarily well, but everyone does okay. The barber notices that there's a new town emerging about 10 or 15 miles away. And he goes out there and he sees that, kind of there's some growth happening, people moving in, etc. And that there are no barbershops in that place because it's brand new. And so what he does is he basically, sublets a small space, puts in a chair, and decides to spend 1 or 2 days a week, starts with 1 day a week at the emerging town. And because he's the only game in town, he can charge more for a haircut. And the opportunity cost for the people who live in that town is that they would have to travel 10 or 15 miles for another barber. And so they're willing to pay a little bit more just for the convenience. And so he goes out there once a week. And since he's the only game in town, and hair grows and people need their follicle trims and so on, and business takes off. And he's doing better than average. He's making more in 1 day there than he does 1 day in the town with a lot of barbers. So he bumps it up to 2 days. Basically he starts spending more time there. And that is the way entrepreneurs go about it. So if you think about what is the risk that barber is taking by stepping into this new town, well, he subleases some very small space. He probably buys some used equipment. He doesn't really have any payroll or anything. He's just going kind of himself. And, he might, for a few days, not have 100% load. So he might lose some business that he would have had in the other place. But the whole risk profile is extremely muted. It's very low. On the other hand, if this town booms, he could eventually be full-time in the new town, and might even be able to hire other barbers to work at his shop. And now he has, at least temporarily, supernormal profits. And so basically, this is kind of classically how a lot of entrepreneurs goes about it. This is the way the Patels went about. The Patels came to the US as refugees. They were thrown out of Uganda by Idi Amin. They'd been there for 100 years, And so Idi Amin said that Africa is for Africans. These guys were Africans, basically. They weren't black, but they had been there for several generations. And they became stateless because he threw them out. And they dominated the Ugandan economy because of their, great approach to doing business. And the UK took some of them in as refugees. Canada took some of them, and the US took some of them. And they basically, all their assets were nationalized. So they lost almost everything. And they were able to convert a few of their assets into gold and get it out of the country. But when they came into the US, they didn't really have too many skills that would have been in high demand in the US. And the motel business looked very attractive because they could live in 1 or 2 rooms of a small motel. A bank would finance 70, 80, 90% of it. And they could employ the entire family into motels are labor intensive, into doing all the different tasks needed for the motel, the housekeeping and front desk and so on. And what happened is the Patels basically accidentally didn't really set out to do this. They became low-cost providers because they had no workers' comp or payroll or anything. And because they were the low-cost provider in a particular area, they could look at what other motels were charging in the area and charge 10 or 15% less and still have the same profitability of everybody else. But when they charged 10 or 15% less, their occupancy went to nearly 100%. And so they had supernormal profits relative to the other motel owners. And this very small group of refugees that came in, I mean, I would say Patels in the US are in the tens of thousands today. They're not in the hundreds of thousands. Maybe they might be 100 or 200,000. But if you look at the US population of 330, 340 million, they're not even 1/10 of 1% of US population. Today, they own north of 50% of all motels in the country. When you're at a motel somewhere, you may not realize it, but you're at a Patel motel. And they've moved upscale into the Marriotts and the Hiltons and all of that. So so amongst the motels, the lower end motels, they have 50, 60% ownership, but even at the higher end ones, they're creeping up on the 15, 20, 25% of those. And it all worked just the way the barbershop worked, except in their case, what happened is, so entrepreneurs start off as arbitrage players. That's really what they're doing. They're arbitrage players. The barber is the classic example of an arbitrage player. And what happens is that over time in that new town, that barbershop's supernormal profits will not last. More barbers are going to come into that town. And eventually, all those extra profits and higher prices that he charges usually will get eroded away. Now, what may happen, sometimes what happens in business, is he's a talented barber and people get used to it. We are kind of creatures of habit and they like him. And if he's very talented, they might be willing to pay him 10, 15% more than anyone else, just because even though there are other barbers available, they now have a habit of coming to him and so on. So sometimes what should be a non-durable competitive advantage ends up becoming a competitive advantage by accident. And that's the same thing that happened with the Patels. What should have been a non-durable advantage actually became a sustaining advantage over a 50-year period. They just, took over that industry. And we see this over and over. So this heads I win, tails I don't lose much is actually the way almost all non-venture back businesses get started. If you look at a small mom and pop Chinese restaurant that opens, they go through the exact same calculus. They look at, okay, I'm looking at Cambridge. Do they have an oversupply or undersupply of Chinese restaurants? Oh, there are too many Chinese restaurants in Cambridge. Let's forget about that idea. How about going, 70 miles away from Cambridge? What's the situation there? And there you might find a town with pathetic Chinese food, and these guys are talented chefs, and they might make it happen. And that, again, non-durable competitive advantage, if they're talented and they get a following, may become sustaining over time. And that's the way capitalism works. And that framework also is applicable in investing. I mean, the important thing in value investing, as practiced by Warren Buffett and Charlie Munger and so on, the very first thing is downside protection. We don't even look at upside until we first look at the downside. And it's just like the barber. The barber doesn't want to lose his shirt when he opens this new place. He's not going to go sign some fancy lease on some big space and put all his savings into that new thing. He's going to scrounge to keep the risk down. And if he does the fancy place with all the razzmatazz, he will be out of business really soon. And that'll be the end of the barber and all of that. So the entrepreneurs that make it, they are arbitrage players. They focus on the downside. And we as investors and value investors, we do the exact same thing. Whenever I'm looking at an investment, what we want is we're looking for free lunches. We want the downside to be zero or as close to zero as we can get with a massive upside. And because we function in auction-driven markets, and because auction-driven markets have a tendency to overshoot or undershoot, things get either too richly priced or too pathetically priced. The richly priced we can leave aside. Don't need to go buy Nokia. That's fine. I mean, sorry, don't need to buy Nvidia, but you can look at things which are hated and unloved. And there's always things that are hated and unloved. And when you get things that are hated and unloved, you can get mispricing in the right direction. And if 7 moons line up where once in a while some great business is hated and unloved for temporary reasons or some temporary issue, and then that can lead to a good result. So that's what we try to do.